All right, let's talk about a super powerful investing strategy that has absolutely nothing to do with trying to pick the next big winner. It's a way to boost your returns that honestly is widely misunderstood. But today, we're going to break it all down step by step.
So what if I told you that the red in your portfolio isn't just a loss, but it's actually a resource, a tool the IRS basically lets you use to chop down your tax bill? Yeah, it sounds almost like a loophole, right? But it is a completely legitimate strategy, and it's called tax loss harvesting.
So here's our roadmap for today. We're going to start by talking about the two big pains that every single investor knows all too well. Then we'll get into how harvesting your losses is basically the antidote. I'm going to give you the exact playbook for something called a sector swap. Then we'll cover the 61-day penalty box you have to avoid. After that, a game-changing loophole for all you crypto investors out there. And finally, we'll actually calculate the tax alpha you could be adding to your own portfolio.
To really get why tax loss harvesting is so brilliant, we first have to talk about the two big pains that come with any losing investment. You've got the obvious financial hit, and then you have the emotional one. Okay, first up, the financial pain. You finally sell a winning stock, you're feeling on top of the world, and then boom, the tax bill shows up. You know, one of our sources put it perfectly, saying that paying capital gains can feel like paying the devil. It's a direct shot at your hard-earned profits.
And then there's the emotional pain. We have all been there. You're holding on to that losing stock, just hoping, praying it'll bounce back, thinking, I can't sell now and make the loss real. But here's the brutal truth. The money is already gone. That value disappeared the second the price dropped. Refusing to sell isn't some clever strategy, it's really just denial.
Okay, so what if we could take the sting out of both of those pains? What if we could take that loss, that gone money, and actually turn it into something valuable? This, my friends, is where we start harvesting.
So here it is, the big idea, tax loss harvesting. It's the strategy where you intentionally sell a losing investment. You're not admitting defeat here, you're being incredibly strategic. You're harvesting that loss to generate something super valuable. Think of it like a tax coupon.
And here's how that little coupon works. Your harvested losses cancel out your capital gains dollar for dollar. But wait, it gets even better. If your losses are bigger than your gains, you can use up to $3,000 of that excess loss to lower your regular taxable income. Yeah, the money you make from your job. That is a direct cash saving.
But I know what you're thinking. It's the big question. If I sell, won't I miss the rebound? And look, that's a totally valid fear. But you don't have to sit on the sidelines. Let's get into the practical playbook for how you can pull this off while staying fully invested in the market.
It's a pretty simple four-step process. First, find a loser in your portfolio. Second, sell it. You got to make that loss official for the IRS. Third, and this is the absolute key, you immediately reinvest that money into a similar but not identical asset. This makes sure you lock in the tax break without ever really leaving the market.
And this is the most common way to do it, the sector swap. So let's say your Bank of America stock is down. You sell it, you harvest that loss, but you still believe in the financial sector, right? So you immediately take that cash and buy a broad financial sector ETF, something like XLF. See what you did there? You officially booked a tax loss, but you were still fully exposed to that sector's potential recovery. And hey, to make this even easier for you, here's a quick toolkit. These are the symbols for some of the biggest sector ETFs out there. If a tech stock is down, you might swap into XLK. An energy stock? XLE. This is the key to staying invested. But, and this is a huge but, doing this right means you have to follow one very, very specific rule, which is arguably the most important part of this whole strategy.
Okay, let's talk about the one thing, the one mistake that can completely blow up this entire strategy. It's an IRS regulation that's like a penalty box in hockey. And if you don't know the rules, your tax savings are going to get completely wiped out.
It's called the wash sale rule. And you can think of it as the IRS basically saying, nice try, but you can't claim a loss if you're just pretending to sell. If you sell something for a loss and then buy back that exact same thing, or something the IRS thinks is substantially identical, within a certain window they call it a wash sale, and poof, your tax deduction is gone.
And here's the part that trips up so many people, the timing. It's not just about what you do after you sell. It is a 61-day window in total. The IRS looks 30 days before you sell and 30 days after you sell. If you buy that same security anywhere inside that window, you've triggered the rule. Now you see why that sector swap is so powerful. A broad ETF like XLF is clearly not substantially identical to a single stock like Bank of America, so you stay safe.
And the penalty? Well, it's not a fine, but it is severe. The loss you so carefully harvested is just disallowed. For tax purposes, it's like the sale never even happened. Your whole strategy completely undone by one simple timing mistake.
So, we know that penalty box is super strict for stocks and ETFs. But what if there was a huge, popular asset class where this rule, it just doesn't apply? This is where things get really, really interesting, because for crypto investors, this is a massive opportunity.
The source material lays it out right there, plain and simple, and this is a total game changer. The IRS currently classifies cryptocurrency as property, not as a security like a stock, and because of that little distinction, the wash sale rule just doesn't apply.
I mean, the strategic difference here is just stunning. With a stock, you sell, you swap, and you have to wait over a month before you can even think about buying that original stock back. With Bitcoin, you can sell it to harvest the loss and then buy it back 60 seconds later. You get the full tax benefit with pretty much zero risk of missing a big rally.
Okay, we've covered the why and the how. Now for the most important part. What is this actually worth? Let's quantify the benefit and see the real proof of how this adds actual money back into your pocket. Let's just walk through a simple before and after. In the before column, you've got $15,000 in capital gains. At a 20% tax rate, that's a $3,000 tax bill. Ouch. Now look at the after column. You strategically harvest an $8,000 loss from another investment. That cuts your taxable gain all the way down to $7,000. Your tax bill? Slashed by more than half, to just $1,400. That is $1,600 in real cash that you get to keep.
So what does this actually mean for your bottom line? Well, that $1,600 we just saved is a 1.6% boost to your net return on a $100,000 portfolio. For free. Financial planners have a cool name for this. They call it tax alpha, and they estimate it can add anywhere from 1 to even 3% to your returns every single year, without taking on a single ounce of extra risk. It is the closest thing you will ever find to a free lunch in investing.
So, the big takeaway here is this. An investment loss doesn't have to be a failure. It can actually be an asset. It's a tool you can actively use to make your entire portfolio more tax efficient. From now on, when you see red in your account, you won't just see a loss. You'll see an opportunity just waiting to be harvested.